Good evening, everyone. I hope that all of you and your families are safe and healthy. On behalf of Stovekraft Limited, I extend a warm welcome to all participants on the Q3 and 9-month FY23 financial results discussion call. Today on the call, I am joined by Mr. Balaji A.S., our CFO, and the Orient Capital team, who are our investor relations advisors. We have uploaded our investor deck and earnings press release on the stock exchanges and on the company's website. I hope everyone had an opportunity to go through them. As you may be aware from our previous press release, Mr. Rajiv Mehta, our CEO, has communicated his intent to move to pursue other opportunities. He played a key role in the growth and development of the company, including successful listing of the company's IPO. We thank him for his contribution and wish him great success in his future endeavor. We would like to assure all our shareholders, employees, customers, and other stakeholders that the company's operations are running normally. The company has implemented a new organization structure to help achieve its strategic goals and support future growth. The revised structure has 4 new executive positions, with the Chief Revenue Officer, a Chief Growth Officer, a Chief Operating Officer, and Chief Human Resource Officer, in addition to the existing position of the Chief Financial Officer. And the team has already started working towards achieving the organization goal. We are actively evaluating candidates for a Chief Growth Officer to drive growth across our 3 brands and the products. And we are also in the process of onboarding the Chief Human Resource Officer. Coming back to the financial results, I am pleased to report that the company crossed the rupees 1,000 crore revenue milestone during this time in the 9-month FY23. With another quarter of consistent performance wherein top line grew by 9%, largely driven by volume uptick. While the quarter encountered a slowdown in overall consumer demand, the company managed to grow faster than the industry. This growth was consistent in both the south and non-south markets. The prices of key raw materials continue to remain steady, which also reflects in our growth, the gross margin growth. The current gross margins have improved from 31.7% in Q3 FY22 to 33.5% in Q3 FY23. EBITDA margins for the quarter stood at 8.1%. I am excited to announce the company is consistently adding company-owned and company-operated retail stores for the Pigeon brand. During the quarter, we have successfully added 12 more stores in Bangalore, taking the total count to 31 stores till 31st December 22. And with new stores being opened in AP, Telangana markets, we continue to expand successfully on the number of stores. Now I will discuss the Q3 performance. The consolidated revenues for the quarter stood at 325 crores versus 298 crores in Q3 FY22, registering a growth of 9% on year-on-year basis. EBITDA for Q3 FY23 stood at 26.4 crores versus 21.5 crores in Q3 FY22. Profit after tax for the quarter stood at 7.8 crores versus 11.1 crores to the corresponding quarter. PAT margins for the quarter stood at 2.4%. Moving to 9-month FY23 performance. The consolidated revenues for 9-month FY23 stood at 1,006 crores versus 875 crores in 9-month FY22, registering a growth of 15% on a year-on-year basis. EBITDA stood at 95.9 crores versus 87.1 crores in 9-month FY22. EBITDA margins reported was 9.5% compared to a 10.0% in the corresponding period. 9-month FY23 profit after tax stood at 41.8 crores versus 47.6 crores in 9-month FY22. PAT margins for the 9-month FY23 stood at 4.2%. Now I would request the moderator to open the floor for question and answers. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Devansh Nigotia from SIMPL. Please go ahead, sir.
Yes, sir. Thanks for the opportunity. So just a couple of questions. So one is, if you could just throw some light on, the reason why, what are the challenges that we are facing in retaining the top level management? Because if you look at last 2 to 3 years, almost everybody has exited the company who had joined. So can you elaborate on what are the challenges that we are facing?
I think the exit of the CEO is what I think you're.
So even during IPO we filed the top level management positions of almost I think 10 to 15 employees, and even within that also there have been exits which includes the earlier CFO and also different business heads that had joined. And including the recent exit of Rajiv Mehta. So the question is overall on the top level management high churn that is happening at the company level.
Yeah, these are 2 positions that we have experienced that we have had change. We have a very efficient CFO that has replaced Shashidhar. Shashidhar used to be our CFO. Of course, these are professional positions, and if they believe that they would want to look at other opportunities and which sometimes are more exciting than what they are currently doing. And I don't think these are in the control of the company. While we continue to excite our team, we are a growing organization from what we used to be in the last 2 years, about say 2,500. We have moved. Today we are a family of 4,500. Yeah, but as your question is valid, we have had 2 exits. Both the CFO in the last 1.5 years and the CEO now has decided to move. It was also both, I can tell you the company is also working to the next level of growth, and so we have broad-based this whole leadership team, and as I mentioned that there are 5 executive positions to take over the current, the leadership team.
Okay. So we are not seeing any internal challenges for the company in retaining the top level management, but we feel that these are all external challenges and opportunities that have come to these top level positions. Is that what we are trying to guide?
Yeah, I think that's the right way to look at it.
Okay. Okay. And can you also just elaborate more on the employee count? Because if I look at the employee cost, last 9 months is 35 crores, and in FY22 on an average per quarter it was 28 crores. So that's like a 25% increase. And if I look at on quarterly basis, on June 21 we started with 24 crores, and December 22 within 8 quarters we are at 39 crores. 39 crores. So that's like I think 70-80% jump in employee cost from 8 quarters back to now, and on an average basis it's almost 25%. So why there is such high employee cost increase? Can you elaborate also on the number of count and the average cost per employee increase?
So there are 2 types. See, we are also a manufacturing company, apart from being a brand and distribution network that the company has. So, in the last 8 quarters that you mentioned, we have also continuously invested on backward integrating many of our facilities. You can see that during the preceding quarter, in spite of a slowdown in demand, we are able to grow and also increase our gross margins. It is to do with the backward integration, the kind of manufacturing facility that we have. These we have added lines, new lines, and also backward integrated. That is where the count from what used to be closer to 2,500, we are closer to a 4,500 people family. The number of people that have gone up. And also you will see that in the last 8 months, there has been substantial growth on the revenue also. So from a 700 to currently we have crossed, in 9 months we have crossed 1,000 crore. So there is a substantial jump, 60-70% jump on the revenue, and corresponding 50-60% jump on our HR cost.
Okay. Also, because if I look at gross margin, they are actually around that range only. It has been in the range of 33-34% only, even if I look at the June 21 quarter against December 22 quarter. So the benefit of backward integration that we are mentioning is actually not very visible, but because now also the commodity deflation has also happened. So I'm not sure if how should we understand the benefits of backward integration flowing in gross margin.
Let me explain to you. On the same time, last quarter, we were at 31.7%. And relatively, the quarter that gone by, demand side was a little softer than what normally is. And we could achieve a 33.5% gross margin. Is close to a 1.8% gross margin improvement under, I can say, relatively testing times.
Mm-hmm. Okay. And the count that we mentioned from 2,500 to 4,500 employees, can you help us understand 2,500 is as on which date?
Exact date is, I can tell you in the last 8 quarters, more or less, from, I'll give you the exact number. March 2021, we were 2,338.
Okay, 2,000.
And plus we had 854. So this is coming to 3,100 on March 2021. In the last 7 quarters, this moved to 4,200. It's not 4,500, it's exactly 4,200.
4,200. Okay.
March 2021.
Okay. And what is the kind of employee cost you are expecting in the next quarter and also for FY24? Any estimates or any expectation on the cost?
So, in terms of percentage, we continue to maintain the same cost. It is only because of the revenue growth, the absolute number has gone up. In terms of employee cost or percentage to revenue, it remains the same.
Sir, actually, if I look at the number, it's actually not same. It used to be around 10% before. If I look at even March 22 or even 9 months, 6 months before this, and even historical numbers used to be around 10.5, but this quarter is actually 12%. So that is why I'm trying to understand the employee cost percentage increase and, how it should be going forward.
Yeah. So for us, when you look at the employee cost particularly, you'll have to look at it on an annualized basis because the cost is annualized. The revenue are not the same every quarter.
Correct. True. So as a percentage, how much we are expecting?
Percentage of our employee cost, but for that subdued cost during COVID, it is all in the same percentage. Currently, I can say we are in the range of 10.5%, and historically also we have been there. But for 1 year of that COVID times when the employee cost was low.
Okay. So we are expecting 10.5% for next year, FY24?
Yeah, I think we'll be remaining in the same range.
Okay. And can you also give us...
This is the growth of the company.
Okay. And what is the data and inventory amount as on December 22?
1 minute. I'll just request Balaji. Balaji, can you tell us?
So our working capital days, I think we opened this year at about 30 to 33 days. Q3 is typically a quarter where, because we are exiting the festive season, which means the demand starts going the spike that we have in Q2. which means typically we have seen that by end of Q3, the working capital looks slightly bloated. So we closed Q3 at about 37 days of working capital. By March, we expect it to expect the number to go, substantially below 30 days.
Can you share the absolute amount of debtor and inventory?
Of inventory and
debtor, trade receivables.
Yeah, so receivables for us would be in the range of about 160, 170 crores, including all the old, including the FRL numbers that we have.
Mm-hmm.
And inventory would be... Inventory is in the range of about 240 to 250 crores. This includes raw materials and finished goods together.
Okay. And how much capex we have done till date, and how much we are expecting for the year, and capex we are expecting for next year?
This year we should close between 70 to 75 crores. We had between 65 and 70. I think doing between 70 to 75 crores for the full year. As of December, we have done about 62 crores of capex.
And next year, what is the guidance on capex?
It will be between 50 to 60 crores.
Okay. We shared the revenue mix between export, general trade, modern trade, e-commerce. So can you share that number?
Yeah, for 1 second.
The 4 channels, export, general trade, e-commerce. This is Q3. Do you want for the quarter?
Yeah, so for the quarter, the mix that we share, export, general trade, modern trade, e-commerce.
Yeah, so for the quarter, general trade would have been about 45%.
Mm-hmm.
Q3 is typically a GT heavy quarter for us. Even e-com, the season is out, and Q3 is also heavily, by the combis that we do. So 45% of GT, e-com would have been about 27 to 30%.
Mm-hmm.
Export would be 10%.
And modern trade?
Modern trade would have been 12%.
Our new outlets, how much? And from our new outlets, how much is the sale?
Retail goods, we are right now at a run rate of about 1 to 1.2 crores per month. We have currently, as of December, we had 31 stores which are operational, including the ones that got opened in December. So the run rate as of December was about 1.2 crores of revenue per month.
And what is the profitability from the new stores as on in December 22 quarter?
So from the retail stores is upwards of 45-46% constantly that we are seeing across all the categories that we are selling. Mm-hmm. And what we are seeing is that within the first 2 months, while so far the stores have been opened in and around Bangalore, and recently we have also gotten into AP Telangana, but similar kind of markets. But we are seeing that within the first 2 months of operations, all stores are becoming profitable.
Okay, got it. Thanks a lot for addressing all questions. I have a few more questions. I'll get back in it.
Thank you. We take the next question from the line of Lokesh Maru from Nippon India Mutual Funds. Please go ahead, sir.
Thank you. Congratulations on a good set of numbers. So my first question is on the volume front, as in if you rate 9% growth in volume versus value or price hikes, if you can guide how much was volume out of this 9%?
Majority of that was from volume, because this is a quarter when we offer substantial offers to our consumers, and there is not much of any price hike. We are not, in the last 2 quarters, we have not taken any price hike. So this is all a volume growth majority. Less than 1% is coming from value.
So also, given that the demand environment is tough, like we have grown, but major competitors have actually degrown. what is our strategy going ahead into the new quarter and the new fiscal? As in, are you expecting any price cuts going forward, or how much of the inventory is flushed, high cost inventory is flushed out, and how much of that growth are you expecting from any new product launches? If you could throw some light on the growth going forward.
So I can say that we will continue to grow, and both because of the existing categories that we are, and consistently that we add on new product varieties and new categories that we keep on adding. Both these should contribute to the growth. And under these, softer demand times, we push ourselves to sell them. And in normal times, definitely we'll grow at a much better and healthier rate than what we are currently growing.
Sure, sir. Understood. Thank you so much, sir.
Thank you.
Thank you, sir. We take the next question from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Yeah. Hello, sir. Sir, I have few questions. You gave out your answers on the employee cost. I just wanted to understand on the other expenses side also. We've seen a fairly high growth, and when I compare the 9-month result, you've done spectacularly well on the revenue growth. But when it comes to the expenses growth, there is fairly high growth. And if you recall, in the past quarters after the IPO, we were saying that there is an operating leverage in the system. But we don't see that. Instead, we see expenses growing much faster than the revenue growth. So first of all, if you could give some comments on that, and how do you see now the expenses panning out on the absolute basis in FY24, not as a percentage of sales, absolute basis?
So currently, we are. I can say that on a quarterly basis, our overall expenses, majority of these expenses are fixed in nature. The major variable for us is the freight cost after in the revenue, apart from materials. Materials, of course, is a percentage again, so it's a fixed number. But apart from this, is a more of a fixed cost. So we portion in terms of percentage again towards marketing spend, which is in the range of the 3.5%. So we believe that if this were the normal AOP, so to say, this quarter we would have otherwise planned to do at least 30 crore more revenue if the demand was normal. And then the percentage would have panned out, that operating leverage you would have seen. Otherwise, on a normal basis, I can say with the current run rate that we have, 20% is the overall cost for us as a company.
So do you see the employee expense side built up already happened in 23, and we'll see an absolute number similar to that in FY24? Looks like
not a very big. There is already, because there are several lines that we have already added, and they are now started delivering. So there is a gestation period from the time when we build the lines to when we start actually delivering. So most of the lines have started delivering. So when the season kicks in, all this will start actually generating enough profit from them. So currently, they are in the embedded cost of the company. On the HR front, I can say the size is, the current cost is what, but for the inflation that we'll have to provide for, otherwise it is at the same level. I think we can manage the FY24.
My second question is on the gross margin side. We are at about this 32-33% gross margin. And I can see that even in Q3 last year, the whole 9 months of this year, whereas there has been a substantial change now in the material price. Why is it that the expanded gross margin is not flowing through? If you could give some color there. I happen to check in other companies also, it has not happened so far. But, if I recall your past calls, you used to say that, aluminium about $2,700-$2,800 is where I see gross margin, shrinking because I haven't taken any price increase. But aluminum now in the last 1.5, 2 quarters has been actually below $2,500-$2,600. But we don't see gross margin expansion. If you could give some comment there, sir.
Yeah, so we are in a fairly competitive atmosphere. It's not that if there is a substantial reduction in the cost of the input, it's not that everything retains in the company. There will always be a lag in what we pass on. But generally, we are a cost plus and we pass on either the benefit or the cost to the consumer. So there you will see some lag. The gross margin growth is not coming purely by material, the commodity price. It is more coming because of the efficiencies and the scale. If you want to have a guideline on the gross margin, so we would want to protect at 31%. That is the minimum that we would want to protect. But our endeavor is to do better. So the range, I can say, on a best case basis can be 35, but in a worst case basis, it can be 31.
So when do we start seeing gross margin expansion now?
Because I think we are already witnessing that gross margin expansion at 33.5 is quite healthy for a quarter 3. The quarter 3, more particularly, I can say, post Diwali was a little soft. Under those circumstances, to ensure continue to grow and the margin that we have worked, we believe that it is a fair margin that the company is able to achieve.
Lastly, these write-offs that we are taking, is it done or there is any more left?
No, we don't have any write-off. Other than the accounting principles that allow for the ECL, I don't think we have any
allowances for credit loss impairment of financial assets. Is it to do with that future retail account or is it now it is something else?
No. So what we had last year was largely because of the future retail where we had to write off close to that 13 crores that we did for the full year. What you're seeing currently is more in terms of what the model throws. So typically the ECL is a model. So given we start providing for a particular invoice from the first day of billing at about 1.5%.
Okay.
So additional revenues and additional receivables, there is that small amount of receivable provision that you see. But typically by Q4 we should have given that we're going to reverse whatever little additional receivables we have by. You will not, see anything that is significant enough on a P&L level.
Okay, understood. So lastly, when I was listening to your initial commentary, you said I'll have CO, CRO, CGO. Now these terms are quite new to me. What are these positions? What is a CR? I can understand a COO, which means that you will hand over the whole manufacturing of responsibility to a COO, operations admin responsibility to a CO. Is that the correct way? What is a CRO? What is a CGO? And are we going to create a Bangalore city office now?
Yeah, all this, let me explain. The CRO is who will be responsible for all the established businesses revenue of the company, like the Pigeon brand, but also the various channels that includes general trade, modern trade, e-commerce, the institutional sales, all the established Pigeon LED business. But there are also new and evolving businesses, like we are building our kitchen business, the retail business. For us, Gilma and Black & Decker also are in the growth stage. So these require different mindsets at the current times. Once they evolve and start working on their own, then they are purely revenue models. So at the growth stage, they are different. So we have two separate responsibilities here. One responsible for the revenue of the company, and that's what we call as the Chief Revenue Officer. And one responsible for the growth of these products or channels. That is what I mentioned, the 4 particular channels. That is the retail channel, Black & Decker business, the Gilma business, and our kitchen business. This will be under the CGO. As you rightly said, COO is the guy who will take care of the manufacturing operations of the company. You also, since you mentioned and asked about the city office, yes, we have identified the place and we will be doing it up in the next 3 to 4 months. So the new city office, the sales, marketing, and the corporate functions will move to the city office.
And what will be your role now in the company?
All these people will report to me.
Okay. Thank you. I'll get back to you if I have more questions, sir. Thank you very much.
Thank you.
Thank you. We take our next question from the line of Pankaj Shah from Dinero Wealth. Please go ahead, sir.
Hi, sir. So actually, last year we had, in continuation with what the last participant was talking, last year we had some one-off where we had written off some debtors and inventory of approx 20 crore. So actually last year other expenses were 142, but that would have been at 122 plus minus. And this year in 9 months we already at 130 crore and probably we might end at 170 crore. So this is a actual rise of 40% as against the increase in sales of 15%. So what is leading to this 40% increase in other expenses?
Largely for the last FY, the first 2 quarters, given they were largely impacted by COVID, we had a lot of restraint in terms of the cost structures. Be it travel, be it marketing spends, anything that was discretionary, there was a lot of restraint that happened, and the tailwinds that we got in terms of the COVID period demand also pushed the sales out. Therefore, I think we explained during the Q1 call as well that the numbers that we are currently looking is more normalized given that there is no COVID, and we are also past our, even in terms of our capex spending, we are current year would be more normalized to look at. So business is more normalized this year, and these numbers are more realistic.
Okay. Your voice is not audible actually, last sentence, what you said.
Yeah, so I'm saying the current structures that we have is more, realistic given that there is no COVID story in the current year.
Right.
Last year, the have remained muted, especially in the first, 5 months and during Q4, where again the Omicron had hit. Okay.
But last year we had taken this one-offs which are not going to recur, or we aren't seeing any of them in this current 9 months.
Yes. So last year we had about 13.5 crores on the ECL, plus I think in Q4 we had about 5.5 crores on the inventory that we had. That 18-19 crores, against that the max that we may have this year would be between 3 to 4 crores.
Okay, so including the one-offs also, we will see a good amount of growth this year in other expenses.
When you look at bio, yes.
Yeah. Okay. And you are saying this is like a normalized spend?
Yes, I think rather if we normalize the last year's spend without the COVID restraints being in place, then the growth would not look as eluded as what it is.
Okay. Okay. And you think when do we see some operating leverage coming in from at the EBITDA level? Because we had earlier guided that we'll protect 11% EBITDA margins, and probably I think we'll be some short of it.
Yeah. So the endeavor is even now to move to that 11%, but I can say that as per the plan, we would have been a little short of between 25 to 30 crores on our revenue for this quarter. There was a little slowdown in the overall demand side. So if it is a normal business, I think we would have been in that range. So we will continue to work on this to retain that 11% EBITDA margin, and we believe that the future AOPs will have a little lower cost side revenue number, but actual revenue number, the target to be a little higher so that we don't miss on this 11%.
Okay. And sir, what is exactly the loss of 6 crore which we see in other gains and losses?
Yeah.
So largely the other gains and losses, what we are seeing for the quarter is and the full year is on account of the forex restatement losses. Close to about 3.5 crores for the quarter ending December was on account of the forex restatement. So these unrealized losses that we have marked to market. If you see by end December, both CNY and dollar had shot up. So whatever long-term liabilities that we have on capex, as well as some the imports that we have, which is typically 2 to 3 months time frame payable period that we have, both of those liabilities have been restated up. That is largely causing that 3.5 crores of loss in the current quarter.
Okay. And sir, on advertising and marketing spend, you said that we spent X percentage, and we were not able to see the demand. The demand wasn't there, so revenues weren't there as such. But is it not logical to spend the percentage based on what revenue is probably there or coming off, rather than spending an X amount and then because we aren't seeing that demand on ground?
So, yeah, we have done fairly well compared to what the industry is doing. And these marketing spends are a budgeted spend that we do based on the annual plan that the company wants to do. And in a normalized situation, what is the revenue that we would want. And anyway, this is in the range of that 3.5 to 4 and well within that range.
Okay, thank you. I'll get back in the queue.
Thank you.
Thank you, sir. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. We take the next question from the line of Mr. Nikhil Gada from Abacus AMC. Please go ahead, sir.
Hi, sir. Thanks for the opportunity. So my first question is in line to the employee expense part, where you sort of mentioned that, it would remain in the range of close to 10.5% for FY24 as well. Now, and then I think after that you mentioned that, it might not be the growth in employee expense would only be sort of inflation related, which would be close to 8-10%. So a bit confused over there. So if you can sort of clarify this number per se, because, if most of our lines are already up and running, and we are not planning, I think we are already backward integrated by close to 85-90%, and hence there might not be any new expansion plans per se. Can you sort of guide on this, please?
No. So to say, the existing lines that we have already put in place are up and running and will start delivering. It does not in any way infer that we are not adding more lines. There is a capex plan, and there are also lines being installed. So we are also increasing our capacities, and also for the capacities that the products that are getting to maturity, there is also a backward integration plan. And so it is not going to be limited to the number of people that currently we have, but it is not disproportionately also growing. So some amount of cost increase will come because with the inflationary thing setting in, and some amount will also be for the new additional employees that will add on to this family. So I don't say, but to assure you, it will not breach the 10.5%, because we also believe that there could be a growth which is higher than in terms of absolute number that will grow because of the 10.5%. So when I say the 10.5%, we are very confident that we can retain our employee cost within that number.
Understood. Okay. So, and just on the, the cost structure front, initially you used to say that, the business is built in such a way that at 31% gross margins with a 20% cost structure, we will be able to achieve 11% EBITDA margins. We are already seeing the gross margins going upwards of 32.5% to 33%, but we are still not coming to that 11% sort of an EBITDA margin. Because of maybe the employee cost going up and even the other expenses. So can you revisit this and help us understand what would be the new guidance in your opinion, or you still stick to the 31 and 11 sort of a number?
So, yeah, in a normalized situation, if the business were to be exactly what we had planned, we would have done better than that 11% and better than the 31%. So for us, we believe that in a normalized situation, the cost of the company will be at that 20%. So with the current margins that we have, we believe that we can do better than that 11%. But particularly in the period that has elapsed, we have seen a little slowdown in the demand. We would have otherwise grown at a little higher number than what we have actually recorded the revenue. So that is why the lag is. We want to continue to assure you that the company will endeavor to deliver that 11%. Maybe there is a miss in 1 or 2 quarters, but we will work to ensure that we deliver at least 11% EBITDA.
Understood. And so just last question from my end. One of our peers was saying that there was heavy level of discounting in the entry-level products, and that is where they saw an impact. And I think we have done well, specifically because we largely target that market. Was there any specific, particular to this quarter, significant discounts or something which we had provided, seeing the market demand and also to stay, maintain your market share and further improve it? And if you can highlight what extra cost was spent over there?
So, first, the third quarter after the Diwali quarter, we believe is always push unless there is a normal demand. And we did definitely experience that the market was slowing down. And so we have our what I call unique property every year during this time. We excite our customers with combo offers. We continue to do that. And of course, that comes at a little relatively lower margin, but because of the advantage that the company had both because of backward integration and also the material cost, that is the basic material cost, the advantage that we passed on, we could retain or have a normal margin that we aspire to. We retained our margin but passed on all the benefits to the consumer, and definitely the offers were very exciting for the consumers. We would have ideally in a normal situation done a little better than what we did. I don't think we did bad, but we could have done better.
But there was a specific cost related to this that we had to splurge on in this particular quarter?
No. Every year during this time, we have these combo offers for our consumers where the channel contributes, we also contribute, and the retailer who actually sells it to the consumer contributes. It's a collective contribution aimed at only benefit to the consumer. It's not that we would have discounted heavily, but the consumer, in the hands of the consumer, of course, it's a huge advantage.
Okay, sir. Got it, sir. Thank you so much. I'll come back in the...
Thank you. We take the next question from the line of Mr. Achal Lohari from JM Financial. Please go ahead.
Yeah, good evening, sir. Thank you for the opportunity. What I wanted to check, if you look at the aluminium, copper, plastic, and so on and so forth, cost would have come down by at least 8 to 10 percentage points for us at the blended basis. So is it fair that, as you said, we passed on most of this cost reduction, backward integration benefits in the market? Is it fair to say that all that got passed on and hence, you kind of, that helped the volume growth? Is that a fair assessment?
Yeah, so anything both when there is a cost reduction or increase, but for a little lag, everything gets passed down in the model that we work. The consumer either stands to gain when the prices go down, or of course the consumer has to pay for if there is a cost inflation. Most of that, it is not in real time, but it gets eventually passed on.
So, in that sense, if you look at this 9%, effectively we're talking about volume growth of upwards of 14-15%. Would that be fair assessment?
I'll tell you that there is some price, there is a cost also, I can say that has contributed, but that's very negligible. It's less than 1%. But all the other the revenue that we have seen, maybe some categories also I have seen a reflection, but the increase in the number of units that we have sold is much higher than that 9%, yes.
So that's what I was saying, because we have passed on the cost reductions and also on top of that the benefits of the backward integration. The volume growth is actually very substantial in a weak demand scenario.
Let me explain to you. If a product that I was selling at 100, and because the cost has come down, I'm selling now at 80, but my revenue has remained 100. Obviously, this is 125%. So I can say that in absolute number terms, it is a much higher growth than the 9%, but in value terms, it is a 9% growth, and in that 9%, majority of that growth has come by volume. But in absolute volume terms, it is a much higher growth. It's not even 15%, it's much higher than that.
Is it possible, because earlier you used to share, in 2021, if I recall correctly, you used to share the number in terms of volume growth category-wise, product-wise. Can you give us some sense about some of those categories like cooker?
We can make a presentation separately on the volume growth, and because we are in several categories, we'll try to do this. I think we will, for everybody, will separately give you out the volume growth numbers.
Right. Sir, the second question I had, given there is an element of seasonality, right? Because we have 2Q and 3Q are heavy quarters. And given we have a larger fixed cost structure, is it fair to say that in third quarter, if it is 7.8%, it would be definitely lower in the fourth quarter, and hence that 11% is actually unlikely in the fourth quarter? Is that a fair assumption?
Yeah, currently with the cost structure that we are currently having, and if at the current gross margins, if we don't hit the revenue number that we aspire, then looks like that 11% may not be, and definitely for the year it is difficult because of currently where we are. But in a normalized situation, so that's what I would mentioned in the earlier to the earlier participant, that we will endeavor to get to that 11% as quickly as possible. For this year, that 11% seems unlikely.
Understood. With respect to, can you help us with the absolute spend, 3Q, of the A&P spending in 3Q and the 9 months?
Only the marketing spend, yeah. Just a minute.
Advertisement and marketing. Advertisement and promotional spending. Which was, I presume, 14 crores in 2Q. Yeah.
Yeah. For the Q3, it was 7.15 crores.
So if it is 7.15, it's actually 2% of revenue. Is that right?
So
in Q3, of course, the spends were lower, Achal. Given and the contribution that comes, right? See, for us, e-com, every rupee that we spend, there's a certain marketing that we have to budget and spend in line with the sales, because it's part of the TOT that we do. Whereas in the non-e-com part, whatever we spend is more structured towards when we run our campaigns per se. So from a single quarter perspective, what you're seeing may look smaller, but if you see for the full year, we'll still be at that between the 3 to 3.5%.
Understood. Sorry if I'm repeating this question. If you could help us with the absolute levels of the e-com exports and branded revenue.
So you want the revenue numbers of export and e-com?
Yeah, for 3Q, sir.
Okay. I can give you all that.
So I think for the quarter, exports would have been between 8 to 10%. Modern retail was about 12%. E-com was close to 30%, and GT was about 45%.
GT was 45%. Understood. And just last question, if I may, sir. You said.
Sorry to interrupt, Mr. Achal. May be requested to join the question queue for your follow-up, as we have a lot of participants waiting for their turn, sir. Thank you. We take the next question from the line of Mr. Rahul Ranade from Goldman Sachs Asset Management. Please go ahead, sir.
Yeah. Thanks for the opportunity. Just two quick questions from my side. So just to understand this allowance for expected credit loss, so will this be a write back in Q4 once you assess the position for the whole year, or how should we think of it?
See, I don't think it's fair to expect a write back in Q4. In one quarter. Largely, we should not see any significant provisions going forward. Write backs can come because significant, more than 50% of the current liability provision that we carry is towards the future retail receivables that we have. Right, I think the cumulative provision that we're carrying is close to 28 crores as on date, and of that, future retail itself is about 15.5 crores that we have. So for write-backs to start flowing in, until and unless we recover some money from the actual liquidation process, that portion is not going to get written back. Otherwise, for the kind of receivables that we have, the other 14-15 crores is fairly in line with what the model asks. As and when we get slightly more efficient in absolute numbers, while I may still get efficient in terms of the number of days of receivables, that will not reflect on the ECL. For the ECL provisions to get reversed, the absolute number of the receivables has to reduce. So given that we are growing at a fairly decent pace on top line, and therefore the receivables amount in absolute terms also would keep on growing in line with that, I don't think it's fair to say that we will start having write-backs on ECL. You should not see any significant, debits to the P&L.
Got it. And you mentioned there was a certain percentage which we use, right, when we create a provision.
So it is so the way the model works is that basis the collection patterns in the last set number of quarters. We use anywhere between 16 to 20 quarters. Basis the actual collection patterns and how the receivables have moved from different aging buckets. Then the model itself determines for different aging categories at what percentages that we have to provide for. To give you a sense, we start providing about 1.5% from the day of the billing. So whatever I would have billed on, let's say, the 29th of December, which is not even due as per the normal credit terms that I have with my customer, still the model will want me to provide for about 1.5%. Right? And it is as high as about, let's say, 65% for anything that is close to 1 year aging. Beyond that, it goes up to 100%. So that's how the model works.
Okay. And this 1.5%, is this getting influenced because of the future retail, because of the large, kind of number there? I'm just trying to understand.
Collection patterns that comes, it is not that 1.5%. I don't want to say that 1.5% is high or low. Of course, minus future retail, all the numbers would have been slightly lower, but it's not that it would have been, let's say, 0 and it is at 1.5% on day one because of future retail. The way the model functions is that there is a certain percentage of provision that you're supposed to take from the day of the sale, and that's how the model works.
Okay. And if I look at the 9-month number, this number roughly works out to 75-80 bits. So there is a provision and then there is a write back, and this is how it keeps on continuing. So the net effect may not be 150 bits. Is that the right way to look at it?
So on ECL, I think for the first 3 quarters, we have provided close to 2.75 crores. For the year, we may not. I mean, for Q4, I think it's fair to say that we may not provide more than another 50-60 lakhs at max. And that's where
I'm just looking at the statutory, the number, kind of in the financial results. So what it shows, it is around a 78 million number on a sale of 875 million, right, for the full year, for the 9 months.
Correct. So again, ECL, we may not be able to relate it to a percentage of sales because it works completely based on the receivables and the collection pattern. I'm saying in absolute terms, it will not, for the full year, it will not cross, 3.25 to 3.5 crores. Understood. And just last question from my side. So this city office that, was mentioned, this is more, a talent retention kind of an effort. Is that the way to look at it?
Yeah, actually, the factory is a little closer to Bangalore, but it is about 30-40 kilometers from the center of the city. The sales marketing function now is a sizable number in the organization along with the finance and corporate function. So for these people, we believe that it is they can operate from the city, and that is why of course it also adds to the talent retention.
Sure. All right. Thanks for that.
Thank you, sir. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to 2 per participant. We take the next question from the line of Harshal Sethia from AUM Fund Advisors. Please go ahead, sir.
Hi, sir. Am I audible?
Yeah.
Sir, I joined late into the call. So I have 2 questions. Firstly, so what is our take on finding a new CEO for the business?
Yeah, so we have a new structure today with 5 executive positions. Apart from the CFO, we are working on bringing one COO, and then we have an internal movement, and where we are going to have a CRO, that is the Chief Revenue Officer. We are also looking out for a CGO to handle our growing businesses, the Growth Officer. We are already identified onboarding one CHRO.
Okay.
And so executive will report to me, and currently this is the new structure.
Okay. Secondly, sir, I have this question. So how do you see the industry planning out in Jan, the demand pickup? Because overall in the last quarter across the whole industry, the sales weren't that good. So how do we see Jan and the quarter panning out for now, Q4?
On a revenue basis, we have grown at about 9% for this quarter. The demand continues to be softer, but I can say the company is doing reasonably well under the current circumstances.
Okay. So can we see that the industry is still growing at the same single digit, but we might be able to reach double digit numbers?
Yeah, we are confident of reaching a double digit.
Okay. So my third question was on the margin front. Our gross margins have been much better.
Requested to join the question queue.
Okay.
Thank you. We take the next question from the line of Ashish from InvestQ Investments. Please go ahead, sir.
Yeah, just wanted to clarify the number on the credit loss that was mentioned for Future Retail and others. Was it something like 20 crore plus that was mentioned?
So I was talking about the cumulative provision that we are carrying in books. What the cumulative number is about 27-28 crores that we have on the balance sheet. Of that, almost 25 crores was provided by March 22 itself. And in the current year, we have provided another 2.75 crores to date in the 9 months. Of that 27.5 or 28 crores, close to 15 crores is on account of the Future Retail receivable itself, where we have provided 100%.
Okay. And so also wanted to understand, is there a different trend in the different verticals that we have on the sales front, as in the exports, e-com, the offline? And if I understand correctly, we had certain regions where we are strong. I mean, I think South we are pretty strong. So there were levers in terms of offline distribution expansion and the additional growth from that. So putting everything into perspective, can you just make us understand how you are looking at these channels overall contributing to the growth that you would be envisaging over the next 1 year?
This quarter and for the 9 months, we have seen good growth on our GD channel, more particularly also, apart from the growth levers that we have, it's also non-COVID times. So the general trade overall has grown much higher. Unlike what in the previous times, during the COVID times, we were seeing very high growth on our e-commerce channels. And with our cost advantage and continuous emphasis on our exports, we are also seeing high growth on our export channels.
So e-com is declining?
I can say for the quarter we are growing, but it is a flat.
Okay.
For the quarter we are growing on the e-commerce.
Sure. Okay.
For the year, because of the previous times, we were not growing. We are a little flattish on the e-com.
Okay. Sure, sir. Thank you.
Thank you, sir. We'll take the next question from the line of Rasmik Oja from Kotak Securities. Please go ahead.
Yeah, thanks. Thanks for the opportunity. So one small question I had was that on the margin front, since we do a cost plus markup basis we sell, and I presume that our products are most competitive on e-commerce. Pigeon is far competitive than any other brands in the same category. Then why can't we actually do a calculation where we keep the EBITDA margin in consideration and do the markup accordingly so that at least the margins are intact, keeping in mind that we are more competitive than the peers. Some comment on this from your side, sir?
Yeah, the endeavor is to maintain the gross margin and to also retain the planned revenue number. If these two fall in place, our EBITDA will automatically get protected. I can say there is a little lag on the revenue number from the planned number that we had for the year, and hence there is a little drop on the expected EBITDA percentage. But as we move forward, I can say that we would want to have a little conservative number on the revenue number, and then so that the planned expenses are in place because they are more of fixed in nature, but for one or two line items. So our endeavor will be to ensure that we protect the 11% in the future.
Sir, similar question, does the management does any analysis that, okay, if we sacrifice certain volumes and increase the markup just to maintain the EBITDA margin, does it make sense on the bottom line of the company?
Now it will continue to see the strategy of the company. We are both driven by growth and protecting the margin. It's not that we would want to throw away our margin for growth, or we would want to throw away growth for margin. Our strategy is that we would want to continue to grow at higher than the industry and protect our margin. So the lever for margin is from the gross margin, and what will flow down to the EBITDA is once we have that revenue number intact, then the the fixed cost that is there, if as planned, if it plans out to be 20%, then automatically we'll have the same EBITDA number that we planned, which is to protect the 11%.
My second question was for Mr. Balaji. If you can just give us some, because someone asked the question, there is other income is negative by 5.2 CR in the first 9 months. There's a 5.2 crore loss over there, and it is mainly because of some forex loss. So how much of the 681 crores of material consumed is imported, A, and out of 1,000 crore revenue, how much is exports? Just I want to understand why this loss is coming in the forex side.
See, for us, imports is all between 40 to 45% of the total materials that we get. While you're seeing 5.9 crores for the year, close to between 3.5 to 4 crores is on account of the unrealized losses which we have restated by end December, owing to a sharp increase in both the CNY as well as the dollar. And this exposure is more on the payable front. As far as the exports is concerned, while we have close to 10 to 12% of our revenues are exports and primarily in dollars, we have been constantly, hedging on between a medium to long term basis, every 9 to 12 months forwards, and those have largely, remained effective for us. Given the payable structures are more short-term in nature on the CNY front, dollar payable is insignificant for us in that sense. This is something that we are working on. Of course, we are discussing, with some consultant in terms of how do we manage these forex fluctuations better. So you should see us getting some control. But the only point is, of that 5.9 that you're seeing YTD, close to 4 crores is the unrealized losses that we have restated just on the December closeout.
Okay. So thanks, Asmal. My small suggestion actually, if the management can going forward actually work out backwards, keeping in mind a particular net margin and an EBITDA margin, then try and actually play around with the volumes and realization will be helpful for the long term. Thanks, sir.
Thank you. We take the next question from the line of Divyesh Mehta from Dinero Capital and Advisors Private Limited. Please go ahead.
Sir, thanks for taking my question. Sir, I have two important questions relating to the employee cost. So, sir, what I was trying to understand is as Balaji said in the initial comment also, that the CapEx expected is around next year around 50 to 60 crore. And we must be adding around 2-3 lines in that of production. So, sir, what I was trying to understand is at the same time, your employee cost will also increase and the other expenses will also increase. But in such difficult business scenario where you are outperforming the industry and you are growing around 10%, but then the same growth will be able to maintain for next financial year because your costs are going to increase with the momentum of CapEx what we are picking up, and the other expenses will also increase. So the earnings momentum, your sales momentum, are you confident about it to maintain for the next financial year, considering the current business scenario?
So for the 9 months, we continue to, at the current, for the 9 months, we have grown by 15% on absolute revenue number. And we are actually growing higher than that when you go by the volume number. And we believe that with the addition of products, new products, with getting advantage in cost and our manufacturing facilities fructifying, all this, we believe that we can grow at even a better rate than current times. Of course, for the last quarter, we could grow on value terms by 9%. We believe that we can grow better.
So any portion of sales which was lagging behind and can come in the last quarter of this financial year?
Can you please explain what is it you want to say?
So I'm saying any portion of the sales which was left over and which has come in the last quarter of the previous quarter due to the billing and the other reasons?
No. So there is if you see Q2 also we had grown. Q2 was a strong quarter for us where we clocked close to 410 crores of revenue. So there is obviously no spillover from Q2 that went into Q3. And Q3 we have grown constantly across geographies, across channels and categories. So yeah, it is not that the growth has come because of there was some spillover from Q2 to Q3, but it is actual growth, and the growth has also been largely on volumes itself. So despite the sluggish market outlook, we have been able to achieve this kind of growth.
Thank you. That's it from my side, sir. Thank you.
Thank you, sir. We take the next question from the line of Devansh Nigotia from SIMPL. Please go ahead, sir.
Yeah, so thanks for the follow. So just wanted to, ask this question once again, but when we're guiding that, the employee cost has increased so much from 2,400 crore, from 2,400 to, 4,200, 4,300, and even then and there has also been a lot of capex in, backward integration and all. But in terms of our gross margin guidance, it is still in the same band. So if you can just, help us understand on the competitive intensity in entry level products and how it has evolved in last 2.5, 3 years, that would be really helpful.
We believe that we are getting the largest segment of the population, and we believe that we would want to continue to deliver value to our consumers. So we will always try our best to add value through by whatever means that bring down our costs, and while protecting the margins that we believe that is fair, and then pass on. With this philosophy and with this business model, we are able to continuously witness growth, both in times when there are fair demand and when there are challenging times. We have been experiencing this, and there are some categories that we have got into, and whenever we have got into the scale of in the state of manufacturing, which is a mature stage for the product, we are seeing that we have got to leadership in many of the categories that we are currently operate now.
And we mentioned in the earlier remark that we are considering shift, sales and marketing team in a Bangalore office. So if you can help us understand at what stage is this discussion right now, and out of the 4,200 employees, how much employees are in sales and marketing, which will be shifted?
Property. And then there is a finishing time that could take between 3 to 4 months, and then we'll move.
And how many sales and marketing employees that we have in our plant as of now?
So we believe that about 150, between 100 to 150 people will move. Is it sales, marketing, finance, and corporate?
Okay. And in terms of our inventory, can you share the breakup between raw materials, finished goods, and work in progress?
More or less, it is in the range of 50-50. We have about 250 crores of inventory. What is approximately?
Okay. Thank you. That's it from.
Thank you, sir. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to the management for closing comments. Thank you, and over to you, sir.
Respected participants, we thank you for your time today, for joining us and understanding the business of the company and us trying to answer all your questions related to the 9 months that have passed by, the quarter just gone. We hope that we were able to answer to your questions. But if there is anything that you need to know, please write to us. You can reach out to our the Orient Capital, or you can also write to our CFO, Balaji. We'll be more than happy to answer your questions. Thank you.
Thank you. Ladies and gentlemen, on behalf of